there's a stock market sell-off, which seasonally, in September and October, there is a correction of 5%, maybe upwards of 10%. I'm not saying that's going to be the case. There's $7 trillion on the sidelines. Half of that is from individuals expanding our money supply because the Fed has been restricted. I'm going to explain that. Credit card loans, car loans, those are short-term borrowing rates, and they are low right now. Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop. Hey, it's KP coming to you live from Corona, California. No music, just me here at 8 p.m. on a Tuesday. Hope everyone had a wonderful Labor Day weekend. Let's get cracking here. I've got a lot to cover, and it is a very busy week. I thought I would get out a third video last week, but it was Labor Day weekend. And to be honest, the PCE report was a snoozer. So, dual mandate, inflation, price stability of the Fed, and low unemployment, labor. Labor is more in focus right now, especially when the personal consumption expenditure came in as expected, which is what I said on my Wednesday video. I thought it would come in as expected. So like 0.273 or 0.277 or whatever it was. Now it's interesting, there's core, which strips out food and energy. And then there's the headline number. And the headline number only went up 0.2. Why? The main reason is because energy has been low. And core strips out energy and food because those prices kind of go up and down. They're volatile, okay? But energy has not been volatile. So contrarian thought here. I mean, we've had a pretty low energy cost for pretty much all year. So I don't know. You're not going to change the methodology of decades of Fed speak and economists, but energy's low, and part of that is our energy policy and getting away with expensive ESG stuff. Like green energy. Not saying we're doing away with it, but just not really pushing that in this new administration agenda, and just getting back to basics and cutting deals and working on trade policy with other countries. So will it stay low for longer? I mean, we just went through the summer. There's two big peak times for energy prices to spike, right? So at the beginning of the summer, when summer travel season kicks off, gas goes up. Beginning of the winter, call it January, February, when heating oil gets expensive because everyone's heating their house. Mild winters, low travel season, less demand destruction. People are worried about prices. Everyone's worried about what's going on in the economy. And so, maybe they didn't take the trips this summer. They didn't drive, and they just kind of hung out and stayed local. I don't know. But, energy stayed low, and it has not been volatile. And so I think the headline number was 2.6, which isn't very high. And in the GDP second reading, so you have like the advanced read, the second read, the final read, the Q2 GDP reading had a pretty low PCE component in it, 2.1, 2%, and a 2.6. So those are pretty low numbers. So we're 2.6 on headline, 2.9 on the core PCE for the monthly reading that is annualized, which is a 12-month look back, which, by the way, July last year was a very low number. So it was going to go up unless we were at 0.1, month over month, which wasn't going to happen because of tariffs. So, I saw the MBS Highway breakdown. Barry and Dan did a good job. Big component in there, just 0.1 of that 0.277 was portfolio management. Now, we all know that the stock market has been ripping new all-time highs again for some of the indices on Thursday. I'm not a financial advisor. I'm not responsible for your losses, only your profits. But have you been out of the stock market? Have you not been participating in this? We're a capital economy. You think about the thing that we provide the most to the world, us, is liquidity. A consumer that spends, a consumer that is generally building wealth, especially if you're a homeowner or invest in the stock market. So I encourage everyone to participate in both because that is the buffer for whatever happens. And by the way, if there's a stock market sell-off, which seasonally, in September and October, there is a correction of 5%, maybe upwards of 10%. I'm not saying that's going to be the case. There's $7 trillion on the sidelines. Half of that is from individuals. And it's just sitting back, waiting for what? An entry point to get back in. Hey, I missed the rally. Stock market's at all-time highs. I can't buy it. Well, NVIDIA just pulled back almost 10% after 56% year-over-year growth only, a few percentage points quarter over quarter, not counting Chinese revenue, which, that could be another $50 billion. So the AI trade is not going away. NVIDIA still has a huge foothold. And I'm not saying go buy the dip because it could dip further. But my point is, you could have a correction. And by the way, what would that do to, management fees? It'd bring them down. And then you'd have a lower month-over-month reading if there's a sell-off for a month or two. GDP came in 3.3 according to the Atlanta Fed. Averaged out with Q1 with all that pull forward and everything else. We're at 1.4% through the first half of the year GDP. That is contractionary. But if that continues to grow and the economy needs more liquidity from the Fed, this Fed rate cut could help. It could help grow our economy. It could help people that are struggling with high credit card debt and car loans and student loans that are about to have their wages garnished starting in October, and all the different things that could impact people, barring them from getting into a house and spending. So the flow of money matters. All this stuff matters. PCE, kind of a snoozer. Friday is the big number. Jobs report on Friday. We've got a slew of jobs data reports coming out over the coming days, just the next 3 days. Jobs week, shortened job week due to the holiday, and the big jobs report on Friday. Now, the estimate is for 75,000 jobs to be created in the month of August, which is basically how quickly they gather data, second half of July, first half of August. Then they revise down June for the final time, revise down July again. And my guess is we'll probably actually come out a little higher on the headline number of 75,000 jobs for August, but I think some revisions to the two prior months will continue because that was the trend. Then we had the QCEW, which is like a quarterly rebalancing coming out next week. We'll see some jobs potentially revised down. That's been the trend. I saw on MBS Highway that Fed Governor Waller thinks there's 60,000 jobs going to be taken out of all the jobs reports. Can you imagine if every jobs report had 60,000 less live in real time because they actually know how to collect data in real time, like most data is collected? I digress again, as usual. Okay, wage growth in the PCE was 0.4%, healthy. Continuing claims last week was down, but still 1.954 million. So we know the labor market is softening. And now an interesting thing happened in the bond market. I talked to a gentleman who works at PIMCO, said they're really big on this bear steepener trade, right? So what they're saying is short-term rates like the 2-year Treasury and the 10-year Treasury will continue to go down because that's usually what the Fed is crushing down when they cut rates and if they're slowing growth and slowing labor. But if inflation is systemic, they see the longer-term rates go up, right? So it steepens. So 30-year fixed, getting close to 5%, the 30-year bond, the long bond as they call it. But it may not be because of systemic tariff-induced inflation, especially if the Fed, board is saying, hey, look, tariffs are a one-time thing. We can look past that. Maybe going up because of the federal judge ruling saying that the tariff policy by Trump is illegal. Now, they were really referring to like the reciprocal tariffs, and so that will go to the Supreme Court, and that will be challenged over months ahead. But the reality is, I read Axios, which is a far left-leaning news rag, Trump-hating news rag, but they have good reporting. And, even when they, try and give Trump some credit for something, they always say it and, well, he's erratic and he's crazy. But, we're raising $30 billion a month in Treasury on tariff revenue, paying down debt. And the long end of the curve, 30-year long bond yields, like our debt and deficit to go down. They like that. Haven't we all been talking about that? And so if this court ruling challenges that and gets upheld, well, then what's going to happen to that tariff revenue, which is debt and deficit friendly and friendly to long bond yields? Well, naturally, you see the long bond yield go up. And as Axios stated, it might not be because of tariffs and systemic inflation. It might be because tariff revenue is being challenged, which is knocking down the debt, which is something we haven't done since the Clinton era. Anyway, and speaking of DC politics, Congress is back only for 3 weeks. There's a Jewish holiday at the end of the month. And so they got 3 weeks to come up with continuing resolution and make sure we have a budget and we can fund our government. So let the games begin in DC. Now, traditionally, new homes have had a more expensive than existing homes because new product, new stuff. Not the case. First time in a long time, the median price of new homes is actually less than the median price of existing homes. Crazy. Inventory of new homes is 9.2 months. Of course, that's not, completed and then going to the market. It's still like 2.5 months, something like that. but it's something to look at. And you know what? Rates coming down has created more home affordability. The Puppy index, Pappy, whatever you want to say, purchase applications payment index, the NBA puts out, has the July payment gone down from 2172 to 2127. Even Redfin's crazy data had it fall to the lowest level since the beginning of the year. They say 2616 for your average payment. So, is the traditional retirement system broken? Social Security is on track to be insolvent by 2033. Inflation is quietly erasing 10 to 20%. So your cash is trash, and your 401k is sitting in a money market, not doing so hot. Not saying, again, rush out and get in the stock market, but that's the best game in town compared to trash cash. And of course, gold is great. Nice little slow mover. Bitcoin, Ethereum are better, my opinion. More modern version of gold. They're all great. You could do them all. Genius of the and. You can do this, and not this or all the others, right? So let's talk about AI real quick, and we're going to Mars. And I'll leave with that at 10 minutes here. Our AI policy is not to restrict anymore. So we're trying to allow chips to be sold even to China, and trying to work that out. Although China's saying, hey, we don't have to buy your stuff. They've got a new chip out. They think they can rival the H20 from NVIDIA that I think Alibaba said they're making. So, we're trying to be strategic with our exports, targeted enforcement, try and get the U.S. tech stack to be out there in the AI chip world, including China. That's a good thing. So one of the biggest buyers of chips and the biggest project in the world, Tesla, is one of the biggest AI projects out there. Well, Elon Musk is also working on SpaceX. He wants to go to Mars. And did you know there's only like 4 windows to go to Mars with the most fuel efficient manner and longest route and return path possible for a manned, womaned and manned route, November 24th, 2026, then December 10th, 2026. And then it's all the way to New Year's Eve on 2028, and then January 16th, 2029. So we got 4 windows. So they're hustling over there. They've been launching these rockets, trying these new systems, had a little breakdown last week, but testing some new systems and new engine cadence. Look, just like when JFK said, we don't choose to go to the moon because we want to, because we have to. So we're going to win this race. We're going to try and go to Mars. We're going to Mars. We've got some windows. Have a wonderful week. I'll get back to you later. Cheers.
Hey, it's KP coming to you live from Newport Beach. It is Friday mid-morning. I've got to run a call here in just a little bit, our national TPO call for wholesale and correspondent. Just rolled off on the last word with Courtney and Christy for the Crispin commentary. And there's a lot to talk about, but I'm not going to talk too long because it's Friday. And we need to get back to locking loans because rates are the lowest they've been again in a year. The 10-year Treasury is rallying. And why? Why are rates getting low? Because the Fed is anticipated to cut after a week, not just the jobs report today, but a week. It's been a week's worth of weak labor data, okay? It started earlier in the week with only 7.2 million job openings on the JOLTS report, job opening labor turnover report. And there are now more unemployed people than there are job openings. First time since 2020. That's not good. We saw the quit ratios kind of stay around 2%. That means people aren't confident that they can quit their job and go find a new one, as they used to be. And ADP payroll was soft, something like, under 54,000 or 54,000 jobs, white-collar jobs, typically in the ADP payroll, a little bit less than expected. Obviously, weekly jobless claims went up, continuing jobless claims kind of stayed around that 1.9-ish million level. But the big news was today, this morning, the Bureau of Labor Statistics put out their August jobs report. Okay. Obviously, they have a problem collecting data, which, it's so funny. Like, we all know that jobs have been weakening and the labor market's been weakening since last November when the QCEW came out, which, by the way, is this quarterly census data where all the states kind of reconcile back with the Bureau of Labor Statistics and say, okay, here's what we really think is going on. So they actually have 95% coverage of all jobs in America. 95%. That's the data we want in real time. Unfortunately, we can't get it. So next week, when we get the QCEW, we will get revisions down for jobs from April of 24 all the way through March of this year. Okay, so we get our final reading on all that data. The estimate is for about 450,000 or more jobs to be revised down from past first Friday of the month BLS labor reports. That's not good, right? And so, so today there was like something like 34,000 jobs created or something like that, but below the consensus of 75,000. But the big number was that the final revision for June was revised to negative. So imagine in June, when we all kind of felt labor was weak, if on the first Friday of July, they said, we lost over 10,000 or 14,000 or 19,000, whatever. We lost that many jobs in the month of June. They would have been cutting at that January Fed meeting for sure. And obviously we got revisions down for May in the last jobs report. This report this morning revised down June. Actually revised it up July a little bit, but the negative month in June and the lower headline number today for August were enough to offset the little bit of increase in July. So labor's weak and the Fed's going to cut. Now, locks will be good right now. I mean, it's all roaring. I would be mindful about price renegotiations. They don't come free in the secondary market. The secondary market where mortgage-backed securities trade is cold, heartless, and unforgiving. Nobody gets free money. So just remember, if you're going back to your own lender where you work for, or you're a third-party originator and you're trying to renegotiate, just remember, like, you've got to make this rate better and for the bar. And, this capital markets teams around the country are going to be hurting. But the offset is there'll be more business. So that's good news. So keep an eye out for a big lock day, big lock week. Now, I know there's a lot of Mr. Smarty Pantses out there. And like, did you know that when the Fed cuts, it doesn't mean that rates go down? Okay, I get it. But when the Fed cuts, it gets people to realize rates could be lower. And by the way, they are at this point. And so if you haven't called your bar, and they haven't called you yet, but they call you because they saw the Fed is cutting the rates or going to cut the rates, don't try and be like, well, you're so stupid. You don't know. Like, I know because I'm in this business. And like, don't make them feel like shit. Just go, yeah, you're right. Like, labor is going down. The Fed is concerned that the economy is slowing. And the good news for you, if you're gainfully employed, rates are coming down to a low in over a year, and they may be sustained at this level. We'll see how labor reports shake out over the next couple months. I'm not trying to, dance on a tombstone here and be excited about weakening labor, but it is what it is. Healthcare has actually been kind of a weak spot for a couple months, and they actually created 31,000 jobs in this report this morning. So will that get revised down, or is that a trend reversal? I don't know. There's an interesting data point to come out of there. Anyway, have a wonderful weekend. Look at that. Just a 5-6 minute video just to try and cap off jobs week. CPI, PPI, all coming out next week. Big inflation data. Midnight tomorrow, I believe the Fed speakers go into the quiet zone, right? Like, they're not allowed to talk until the actual Fed meeting after. So all the Fed speakers are done speaking this week, and then they go into their quiet period. So let them rest in peace. Have a great weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.